So the Bank of Canada just held its rate at 2.25%. And if you're like most Canadians, you probably saw the headlines, shrugged it off, and moved on with your day. But if you're retired or getting close to it, I want you to pay attention, because where interest rates sit and where they're headed has an impact on how much income your portfolio generates, how you should be drawing it down, and whether the plan you built 2-3 years ago still even makes sense today. I'm Kris Dureau with Green Private Wealth. Our mission is to help Canadian families turn financial complexity into a clear, actionable plan so you always know where you stand and how your future is protected. So in this video, we're going to break down what this rate hold actually means in plain terms, how it specifically affects your retirement income plan, and what adjustments you should be thinking about right now. So let's get into it. First, let's set the stage for what actually happened, because the context here matters a lot. Back in the summer of 2024, the Bank of Canada started cutting rates aggressively. Over the course of about a year and a half, they cut all the way down from 5 to 2.25%. That's a 275 basis point drop. And now they've stopped. The January 2026 decision was a hold. December before that was a hold. And most economists right now believe the cutting cycle is effectively over unless something dramatic changes with the economy or the trade situation with the United States. So what does this mean? It means we're likely sitting in a stable rate environment for the foreseeable future. Not the high rate environment of 22 and 23, not the near zero environment of 2020 and 21. Something in the middle. And for retirees, that middle ground has some very specific implications. Let's start with the most direct impact and what's happening with the fixed income in your portfolio. If you built or rebuilt your fixed income allocation during the high rate period of 22 and 24, you may have locked in some genuinely attractive yields. GICs at 5%, 5.5%, even touching 6% for a period. Bond yields elevated. High interest savings ETFs actually paying something meaningful. Here's the reality now though. A lot of those GICs are maturing and coming up for renewal. And when you go to reinvest that money, you're not getting 5% anymore. You're looking at something closer to 3, 3.5 on a 1 to 2 year GIC, depending on the institution and the term. That's a real income reduction for a lot of retirees. If you had $500,000 in GICs at 5%, that was $25,000 a year in interest income. At 3.25%, that same $500,000 is generating just over $16,000 now. That's nearly a $9,000 annual drop in income from the same pool of capital. And if your retirement income plan was built around those higher rates, which a lot of plans from 22 and 23 were, then you have an income gap that needs to be addressed. Now here's what a lot of people do in this situation, and it's a mistake. They either chase yield by moving into a riskier fixed income, high yield bonds, longer duration bonds without fully understanding what risk they're taking on, or they just accept the income reduction and quietly reduce their spending without actually revisiting the plan. Neither of those is the right answer. What you actually need is to look at whether the overall income structure of your retirement plan still works at the current rate environment, and if it doesn't, what levers do you have to pull? Here's something that catches a lot of retirees off guard when it comes to fixed income, and that's the relationship between interest rates and bond prices. When rates go up, bond prices go down. And when rates go down, bond prices go up. There's an inverse relationship. Most people know this in theory, but here's what it actually means for you right now. If you hold bond funds or ETFs in your portfolio, not individual bonds, the unit value has been climbing as rates came down over the past year and a half. There's a capital gain sitting in your portfolio that wasn't there 2 years ago. Now that rates appear to have stabilized, you're not going to get that same tailwind anymore. The price appreciation phase of the bond cycle driven by falling rates is likely behind us. What you're left with is the yield, which, as we just covered, is lower than it was. So, if you've been holding bond funds and telling yourself the total return is fine because the unit price has been going up, you need to reassess, because that price appreciation has a one-time benefit of the rate cutting cycle. It doesn't repeat in a flat rate environment. Now let's talk about something more strategic, and that's how the rate environment should be influencing how you draw income in retirement. One of the things we look at very closely with clients is the sequencing of income. For example, you've got CPP, OAS, rrif withdrawals, non-registered income, and possibly a defined benefit pension or rental income. And then of course TFSAs on top of that, depending on the situation. How you layer those sources and in what order has a massive impact on your lifetime tax bill. Here's where the current rate environment creates an interesting planning opportunity. With the Bank of Canada holding rate at 2.25% and growth expected to remain modest, We're likely in a low growth, stable rate environment for the near term. Inflation is sitting close to the 2% target. That's actually a relatively favorable backdrop for retirees. Your purchasing power isn't being eroded at the same pace it was in 22 and 23. But here's the opportunity a lot of people are missing. If you're in your early 60s and you haven't started CPP yet, the calculus on when to take it is worth revisiting right now. With rates stabilized and fixed income yields having come down, the guaranteed inflation indexed income that CPP provides becomes relatively more attractive. CPP increases with inflation every January. It doesn't go down when interest rates fall. It doesn't mature and needs to be reinvested at a lower rate. It just pays for life. For a lot of people in this rate environment, deferring CPP to 65 or even 70 while drawing from registered or non-registered assets in the meantime makes a lot of sense because you're replacing what used to be the reliable yield from your fixed income portfolio with something even more reliable, a government guaranteed inflation index payment that you can never outlive. Let's talk about the asset allocation question because the shift from a 5% rate environment to a 2.25% hold changes the math on a lot of investment decisions. When rates were at 5%, cash and short-term GICs were generally competitive with equities on a risk-adjusted basis. You could earn 5% virtually risk-free. A lot of retirees reasonably moved more conservatively and held heavier cash and GIC allocations during that period. Made sense. A 2.25% to 3.5%, that trade-off looks very different. Inflation, as I mentioned before, is around 2%. So your real return on a 3.25% GIC is barely 1% after inflation. Over a 20 or 25-year retirement, a portfolio that's too heavily weighted in cash and short-term fixed income at these rates is going to struggle to keep pace with your actual cost of living. Now, I'm not saying everyone should just be moving aggressively into equities. I'm not saying that at all. That's not the point. The point is that the shift in the rate environment is a legitimate reason to revisit whether your current allocations still aligns with your income needs and your long-term purchasing power goals. If your allocation was built for a 5% rate world and we're now living in a 2.25% hold world, it might need to be recalibrated. For most retirees in this environment, that probably means holding a little less cash and short-term fixed income, a little more in dividend-paying equities or balanced equity exposure, and making sure the fixed income you do hold is working as hard as it can. Now, I want to address something that's sitting in the background of all of this, and that's the uncertainty around US trade policy and tariffs. The Bank of Canada mentioned in its January statement the trade situation with the United States is the biggest wild card in the Canadian economic outlook right now. If tariffs escalate significantly, that could push inflation back up, which might force the bank to reconsider rate hikes, or it could slow growth so dramatically that they have to cut again. For retirees, the lesson here isn't to try to predict what happens. Nobody knows. What it means is that your retirement income plan needs to be resilient enough to handle both scenarios. You don't want a plan that only works if rates stay exactly where they are. You want a plan that has enough flexibility built in it through diversification, through tax-efficient income structure, that it holds up whether rates move up, down, or sideways from here. The retirees I've seen navigate rate cycle uncertainty the best have one thing in common. Their income plan wasn't built around a single assumption about rates. It was built around multiple income sources, some guaranteed and indexed, some market-based, some tax-sheltered, that together create a reliable, flexible income stream regardless of what the Bank of Canada does next. So here's what I want you to take away from this. The Bank of Canada holding at 2.25% isn't just a mortgage headline. For retirees and near retirees, it has real tangible implications for your income, your portfolio, and your plan. If you built your retirement income around GIC rates of 5% or higher, that income is likely dropped and you need to revisit whether that plan still holds. If you're holding bond funds expecting continued capital appreciation from falling rates, that tailwind is likely behind you. If your allocation was calibrated for a high rate environment, it's worth reviewing whether it's even still appropriate. And if you haven't thought seriously about CPP timing in light of this rate environment, it's worth having that conversation. None of these are panic moves. They're the kind of regular, thoughtful adjustments that a good retirement income plan should always be making in response to a changing environment. The plan is never static, and a rate cycle shift is one of the most important moments to make sure yours is still working the way it's supposed to. If you want to sit down and actually stress test your retirement income plan against where rates are today and make sure the income, the allocation, and the drawdown strategy all still hold up, use the Calendly link in the description to book a one-on-one session with our team. This is exactly the kind of review that every retiree and near retiree should be doing right now. Give this video a like if it gives you something to think about. Share it with someone you know who's planning for retirement, and subscribe for more content on navigating your financial future in Canada. I'm Kris Dureau with Green Private Wealth. Thanks for watching. We'll see you in the next one.